Hello, I'm Saffron Sweeney and I'm a Principal and Actuary at Aon, specialising in super. In this video, I'll be discussing the superannuation changes that became effective from 1 July 2017 and provide further insight on the subject. Please note that this video is for general information purposes only, and therefore I recommend that you speak to a qualified financial advisor who can provide you with advice based on your personal circumstances before you make any changes to your superannuation. There are a number of important changes to super that took effect from 1 July 2017. The first is that the concessional contributions cap has decreased to $25,000 for everyone. This cap includes your superannuation guarantee, known as SG, contributions, and any salary sacrifice or pre-tax contributions you make. Note that the amount is per person. It is not reduced if you work part-time. Additional tax applies if your pre-tax contributions exceed the concessional limit based on your marginal tax rate, less the 15% already charged. The ATO charges any additional taxes above the standard 15% to you, and you can elect the super fund to pay it out of your super account on your behalf. Note that these excessive contributions are then classed as non-concessional contributions and count towards the non-concessional cap. Another change that occurred is that you are able to claim a tax deduction for the post-tax contributions you make into super. They would then be classed as concessional contributions. There have been no changes to standard concessional contributions tax, which is 15%, or the tax refund for low-income earners. From 1 July 2017, a high income earner tax now applies to those whose income plus super contributions are above $250,000, and this is applied to the concessional contributions. So if your adjusted taxable income, including super contributions, is under $250,000, then the tax on your concessional contributions below the $25,000 limit is 15%. Or if it's over $250,000, then the tax on your concessional contributions below the $25,000 limit ranges from 15% to 30%, depending on your situation. I'll take you through some examples on the high income earner tax. With the first example, the combined income and SG is under $250,000. So the tax on the contributions is 15%. With the second example, the income by itself is above $250,000. So the total contribution is taxed at 30%. With the third example, income is under the $250,000 limit, but combined with the SG gives a total of $262,800. As this is over the $250,000, then contributions tax will be partially based on a 30% tax rate and partially on a 15% tax rate. Similar to contributions made above the concessional limit, tax above the 15% rate will be charged by the ATO to you, and you can elect for the super fund to pay it from your account balance on your behalf. Now I will talk about the changes to non-concessional contributions effective from 1 July 2017. Non-concessional contributions are made from your after-tax money, such as from your bank account. You've received your salary and paid tax on it. You can contribute this money into super as a non-concessional contribution. There is no contributions tax applied to non-concessional contributions. The non-concessionable contribution cap has been reduced to $100,000 each year. Note that if your total super balance is over the transfer balance cap, which is currently $1.6 million, then you are unable to make a non-concessional contribution into super. However, you can continue to make concessional contributions. If you are under age 65, you are able to bring forward up to 3 years of non-concessional contribution limits, but then you can't make any further non-concessional contributions for the next 2 financial years. However, due to the introduction of the transfer balance cap, the bring forward rules have had to be amended. Basically, if your balance is at 30 June in the financial year before you make the contribution, will be used to determine how much you can contribute as a non-concessional contribution. The only other change to non-concessional contributions that may benefit some of you relates to spouse contributions. You are able to make a contribution to your spouse's super, and depending on their level of income, you may then receive a tax offset of up to $540. Your spouse's income now has to be under $37,000 to claim the full offset, and the offset will reduce if your spouse's income is between $37,000 and $1 or up to $40,000. This applies as long as your spouse hasn't exceeded their non-concessional contribution limit for the year, or their total super balance just before the start of the relevant financial year is above the transfer balance cap. From 1 July 2017, it is only possible to move your super into a retirement pension that has tax-free investment earnings up to the transfer balance cap. Any amount above this will need to be taken out as a lump sum or left in the accumulation phase, where investment earnings would continue to be taxed at the concessional rate of 15%. A transition to retirement pension doesn't count towards this transfer balance cap because from 1 July 2017, the earnings are taxed at 15%. If you have a large amount of super and pensions, we recommend that you seek financial advice to ensure you don't breach the transfer balance cap. I hope you have found this presentation useful. Should you have any questions about these changes or your superannuation more generally, please contact the Aon Advice Centre. Thank you.